Most people think saving money and investing money are basically the same thing because both feel responsible, both involve self-control, and both create the comforting sense that you're preparing for the future, but financially they operate in completely different worlds. Saving is defensive. Investing is productive. One protects money from disappearing while the other attempts to make money participate in economic growth, and understanding that distinction changes the way people think about every dollar sitting in their account. Imagine two people who both manage to save the same amount every month for 10 years. They earn similar salaries, live in similar apartments, and avoid major debt. On the surface, their financial habits look identical, but one person keeps nearly everything in cash while the other slowly moves a portion of those savings into investments over time. At first, the difference between them is almost invisible because in the beginning, investing rarely feels dramatic. Most people expect investing to look exciting, fast, or obvious, but the early stages are quiet and mathematically unimpressive. The first few years often feel slower than people expect because the money being invested is still too small for compounding to become emotionally noticeable. This is where many people stop. Saving feels safe because the number in the account never appears to go down during normal market fluctuations, while investing introduces uncertainty, movement, and temporary volatility. Human psychology naturally prefers visible stability over invisible long-term growth. Behavioral economists have studied this for decades and consistently found that people feel losses more intensely than gains, which means the emotional pain of seeing investments temporarily decline often outweighs the rational understanding that markets historically move upward over long periods of time. But there is another risk that feels less emotional because it happens slowly and quietly. Inflation gradually reduces the purchasing power of idle cash. A person may look at their savings account and feel financially disciplined because the number keeps increasing, yet the actual value of that money relative to housing, healthcare, education, transportation, and food may not be growing at the same pace. This creates a strange financial illusion where people become better savers while simultaneously becoming weaker long-term owners of purchasing power. The transition from saver to investor is really a transition from preservation to participation. Saving alone means your money remains disconnected from the systems that create economic expansion. Investing means your money becomes attached to businesses, infrastructure, innovation, productivity, and long-term market activity. Instead of money simply existing, it begins working inside larger financial systems that continue moving whether you personally participate or not. A useful way to understand this is to compare money with stored energy. Savings are potential energy. Investments are kinetic energy. One remains stationary while the other enters motion. Economies reward movement because modern financial systems are fundamentally built around ownership. Large fortunes historically were not created through storing currency alone, but through owning productive assets that appreciated or generated returns over time. Stocks represent ownership in companies. Bonds represent participation in lending systems. Real estate represents ownership of physical assets connected to economic demand. Even index funds, which many long-term investors prefer because of their simplicity and diversification, are essentially systems for owning tiny portions of many businesses at once. What makes this difficult psychologically is that saving produces immediate emotional rewards while investing often delays emotional satisfaction. When people save money, they can open their banking app and instantly see the result. Investing works differently because its most important effects are delayed and exponential. The real power of investing usually appears later, after consistency has been maintained long enough for compounding to accelerate. A tongue sticking out 1 plus N R. This equation represents compound growth, and although it looks simple, it quietly explains why time matters more than intensity in long-term investing. The reason consistent investors often outperform inconsistent high earners is because compounding rewards duration more heavily than occasional bursts of contribution. A smaller amount invested consistently for decades can eventually surpass larger amounts invested sporadically because growth begins building on previous growth. This is also why the emotional relationship people have with investing matters so much. Many beginners think investing is primarily about choosing perfect stocks, predicting markets, or reacting quickly to financial news, but historically the larger factor has often been behavior rather than prediction. Panic selling during downturns, chasing trends during market euphoria, or investing emotionally after social pressure frequently damages long-term results more than lack of technical knowledge. The healthiest transition from saving to investing usually happens gradually rather than dramatically. Financial stability still matters because emergency savings create psychological resilience. People who invest without any financial cushion often panic during uncertainty because every market fluctuation suddenly feels personal. Savings create protection. Investments create growth. Strong financial systems usually require both working together rather than replacing one another. Over time, something deeper begins changing beyond the math itself. People slowly stop viewing money only as something they earn through labor and begin viewing it as something that can also represent ownership, patience, and long-term positioning. This identity shift is subtle but important because economies increasingly reward ownership structures more than simple participation in labor alone. The people who understand this early often gain more time for compounding to work quietly in the background while everyone else waits for the perfect moment to begin. The strange thing about investing is that its biggest advantages rarely feel dramatic in real time. Most wealth accumulation looks boring while it is happening. There are no cinematic moments when compounding suddenly announces itself. Instead, there are years of ordinary consistency, small repeated decisions, and gradual participation in systems larger than any individual paycheck. Eventually, the gap between saving and investing becomes visible, not because one person worked infinitely harder, but because one allowed time and ownership to begin working alongside effort instead of relying on effort alone.